there is a big cycle we're going to talk about that only if you study it over hundreds of years can you actually see the nature of this cycle. And we're in a big cycle.
I studied the 10 most powerful empires over the last 500 years and the last 3 reserve currencies. It took me through the rise and decline of the Dutch Empire and the guilder, the British Empire and the pound, the rise and early decline in the United States Empire and the dollar, and the decline and rise of the Chinese Empire and its currencies, as well as the rise and decline of the Spanish, German, French, Indian, Japanese, Russian, and Ottoman empires, along with their significant conflicts as measured in this chart. To understand China's patterns better, I also studied the rise and fall of Chinese dynasties and their monies back to the year 600. Because looking at all these measures at once can be confusing, I'll focus on the 4 most important ones: the Dutch, British, U.S., and Chinese. You'll quickly notice the pattern. Now let's simplify the form a bit. As you can see, they transpired in overlapping cycles that lasted about 250 years, with 10 to 20-year transition periods between them. Typically, these transitions have been periods of great conflict, because leading powers don't decline without a fight. So how am I measuring an empire's power? In this study, I used 8 metrics. Each country's measure of total power is derived by averaging them together. They are education, inventiveness and technology development, competitiveness in global markets, economic output, share of world trade, military strength, the power of their financial center for capital markets, and the strength of their currency as a reserve currency. Because these powers are measurable, we can see how strong each country is now, was in the past, and whether they're rising or declining. By examining the sequences from many countries, we can see how a typical cycle transpires. And because the wiggles can be confusing, we can simplify it a bit to focus on the pattern of cause-effect relationships that drive the rise and decline of a typical empire. As you can see, better education typically leads to increased innovation and technology development, and with a lag, the establishment of the currency as a reserve currency. You can also see that these forces then declined in a similar order, reinforcing each other's decline. Let's now look at the typical sequence of events going on inside a country that produces these rises and declines. In a nutshell, the big cycle typically begins after a major conflict, often a war, establishes the new leading power and the new world order. Because no one wants to challenge this power, a period of peace and prosperity typically follows. As people get used to this peace and prosperity, they increasingly bet on it continuing. They borrow money to do that, which eventually leads to a financial bubble. The empire's share of trade grows, and when most transactions are conducted in its currency, it becomes a reserve currency, which leads to even more borrowing. At the same time, this increased prosperity distributes wealth unevenly. So the wealth gap typically grows between the rich haves and the poor have-nots. Eventually, the financial bubble bursts, which leads to the printing of money and increased internal conflict between the rich and the poor, which leads to some form of revolution to redistribute wealth. This can happen peacefully or as a civil war. While the empire struggles with this internal conflict, its power diminishes relative to external rival powers on the rise. When a new rising power gets strong enough to compete with the dominant power that is having domestic breakdowns, external conflicts, most typically wars, take place. Out of these internal and external wars come new winners and losers. Then the winners get together to create the new world order. And the cycle begins again.
I'd like to describe that there are 5 main forces that we see repeat over those times, and those were indicators of power. But the 5 main forces are There's the debt, money, economy force. How much can you increase debt? How does the mechanics of that work? I'm a financial guy. We live in that world, so we can talk about the mechanics of that. The second is the internal political force, which there's a cycle of cooperation and confrontation. When there's large wealth and values gaps, we see much greater populism and extremism, and which each side says, fight for me. And the idea of compromising doesn't, and working well together becomes a problem politically. And we see that that becomes worse and worse. So that force with the debt force is happening. We can see the political nature, that populism of the extreme and how it's working is very much with us. And the last time that that happened, you'd have to go back to the 1930 to 45 period. Number three is the geopolitical conflict, the great powers conflict. Graham Allison described the Thucydides trap. In other words, there's an order that described here. When you have a winner of a war, they set the rules. So in 1945, the United States won the war, was the dominant power. That's why the United Nations is in New York and the World Bank and the IMF are in Washington, D.C. The dollar is the world's reserve currency. We got a monopoly on military power. And then there's a cycle. Number three is the external. Who is in control? What are the rules of the game? Number four, throughout history, even more important than the first three, is acts of nature, drought, floods, and pandemics, have killed more people than wars, have toppled more orders than these other items. And certainly today, climate is a big one. And number five is throughout history, man's inventiveness, particularly of new technologies, has had revolutionary effects. And certainly that is a factor today in an almost unparalleled way. And then when you see the story repeat over and over, what you see is that how they interact. When you line them up and how they interact, they create the great cycle. So for example, when you have a lot of, let's say, debt and vulnerabilities, and you have a political conflict and an external conflict, and the same time as you have climate disruptions or costs, we have big costs. It's estimated that the climate issue is going to cost us $8 trillion a year, which is 8% of world GDP. And then we deal with the technology. We're in that kind of transition. So when we talk, I think when we talk about anything, it falls into any one of those categories. Everything important falls into one of those categories, and they relate to each other. The beautiful thing about studying history and so on doesn't mean that history is necessarily going to repeat, but everything that happens has causes that make it happen. And so you could see the cause-effect relationship. So when we deal with the question of how much debt is too much debt, there are mechanical issues that determine that. So there's a debt asset and a debt liability. One man's asset is the other man's liability. You're holding the bonds to lend to somebody else. So that means that interest rates have got to be high enough for the creditor, but not too high for the debtor. And when you have that rise, that balancing act becomes more and more difficult. So there's mechanics behind this. So what you have is as your debt rises relative to your income, naturally your debt service payments rise relative to your income. And if you have interest rates rise relative to that, the debt service payments rise at a faster rate. And the government is always the one of last resort. So what we saw through COVID and what we're seeing now is the government being of last resort and the central bank going in and buying that debt. So if you take the government's numbers and its deficit, we are almost out of discretionary spending ability because we have commitments for social programs, many, many different things. And so that debt service payment is going to start to produce a squeeze. That means, do you pay less? Or do you tax more? Or do you borrow more and print it? And so there's a curve that you enter into mechanistically in which the debt service payments compound and accelerate to create a squeeze. That's the first of the drivers. But what happens in that process is the second driver is, do you want to hold the bonds? We think of the supply and demand for credit as being how much new bonds have to be sold and how much will they be bought by the buyers? And that's going to be a challenge. But when you get to the situation where they might want to sell their debt, let's say we have in the government $34 trillion of debt. If you get to that dynamic, and that's the dynamic to watch, where they're selling, that increment of the debt selling to fund the deficits becomes very large. Then the central bank is in a position of what do? They could either let the balance clear. If they let the balance clear and don't print money and come in, then the interest rates are going to go through the roof because it has to ration new credit. And so that causes a terrible disaster. Throughout history, they always give in. It depends how long it takes. The reason we had the Great Depression is from 1929, it took to 33, and then they printed money. And so we know in the end they will do that they will print money. So that dynamic, as we start to carry through, that squeeze begins to accelerate. And the key question is, when does it take people selling those bonds? And that's a real interesting question because throughout history, always the temptation is the interest rate. And we tend to look at interest rates in historical context. Are they high enough? But not taking that consideration. So in history, since 1700, there have been about 750 currencies. A currency is an interest rate, is a debt instrument. There have been 750. Only 20% of those currencies still exist, and those 20% of the currencies have all been dramatically devalued. So the answer is you cannot continue this. I mean, it would be so great if it was, wouldn't that be terrific? But it's not like that. I think sometime within the next 3 years, we're going to see some form of a crisis pertaining to this. Now, the question also becomes some of the other issues. There are things going on in which maybe foreigners do not want to buy the bonds. There's worries about sanctions. There's this geopolitical. When the geopolitical takes hold, the question is even what is a storehold of value? So we have the political. The political will be very important. If we get into what would Trump's policy be, what would Biden's policy be? They all have policies of spending more and not taxing enough to bring that. So you're going to have this dynamic. Xi Jinping said there's a 100-year storm on the horizon. And they are entering this 100-year storm. So if I go down their list, what they had is they had a debt bubble with the real estate, okay? And they are dealing with that. They have to do a debt restructuring. So 70% of their savings was in real estate. 20% of their economy was in real estate. So they're losing money. The person and the banks and everything gets squeezed by that. The second thing is then their stock market goes down and their salaries are going down. You're having this big wealth effect, and that's negative. The internal control issues. Okay, now you have a different approach. In one case, like they would believe capitalism and the chaos that you're going to produce from your political system will get out of control and you don't have order. That's what they would say about the United States. And then you get the opposite extreme, which is an autocratic, almost dictatorial type of system. Both have real problems. Both are difficult. And so when you take the dictatorial type of problems and so on, in doing that, that's creating a fear and a control element. And that at the same time is that the conflict with the West is also creating a great fear. You don't know which side's going to get you. One of the things that I learned from making a big mistake was the importance of effective diversification. So my mantra for investing is to have 15 or more good uncorrelated bets, return streams, okay? So, because no matter what, the day's going to come along that when you have a concentrated bet and you're wrong, you're going to pay for it. So first of all, how do you have the 15 uncorrelated bets? Then you have to realize you can't look at the stock market. You have to get granular. What is the stock market? It's just a bunch of different things that are going in different directions. If you were to say commercial real estate, you would be in the tank. If you say artificial intelligence related company, you're through the moon, okay? So you have to begin to think about where is your edge in being able to pick some things, okay? And then you have to think about where. I do believe global is good, okay? So I'm a global macro investor. I look at a lot of countries. I think there's environments. What I want in investments are three basic things and where I'm going to invest. Are they earning more than they are spending? Do they have good income statements and balance sheets? And I do that when I think about countries, because you'll pay. Do it. Internal conflict. Are they orderly and operating efficiently in a healthy, competitive environment? And do they have order, or do they have disorder? And number three, are they at risk of a war, an international war? And then I look at other measures of health. I put out, and you can go online, I give it away, an assessment of each country through statistics, level of indebtedness. And I look for the bright spots. Okay, there are bright spots in this world. The world looks very different depending on where you're sitting. And so as you looked at places like the ASEAN region, okay, if I'm in Singapore and I'm looking at Indonesia and Philippines and Vietnam and so on, or I look at India, or I look at parts of the Gulf countries, the Emirates, Saudi and these places, or then you look at the dynamics, how offshoring has benefited Mexico in terms of then exporting into the United States because of the nature of the dynamic. I look at those things to take those. So I would say diversification, know the basics of what that environment is going to be, including the issue of taxation, tariffs, those kinds of things. So the places that I don't like bonds, okay, it's going to take a long time. So if I take a bond yield, okay, simple way of how do I look at a bond? Take an inflation rate. You could pick the number. A low estimate would be 2.5% here. Then you need a real return. You need a 2% or so real return. I think it's riskier than that because you may have this supply-demand problem. You would just look at those numbers. You'd say, okay, 2.5 plus 2 is 4.5. 2.5, 3 plus 2, okay, is 5. Okay, on that normal. And so I start to look at the bond market. And right now we have a big easing built into the curve. Like, okay, there shouldn't be this big easing in there, all things considered. And then we got this big debt thing going on. Like, I don't want to own debt because I think that that's a problem longer term. Okay. Yeah. And so that gives you a sense of how I look at the world. And I think you have to pay a little bit of attention to gold.
Yeah.
Because gold is I'm not saying a big thing, and gold is an overlay. Because if you look at history and you understand the nature of the value of money, it's a negatively correlated, in big events, it's a negatively correlated asset, particularly in those environments. So if you're think about portfolio construction. The most important thing that you all, if you're becoming investors, that need to understand very well is portfolio construction. And that could be of betas, in other words, asset classes, or it could be of alphas, but you have to have that portfolio. And so as you get acquainted with that, that'll help you to create the better diversification.
I view life as transpiring in phases, and maybe three big phases. The first phase is you're dependent on others, your parents, you learn. Then you come out to the real world and you try to be successful. And then you go on to the third phase in life, where that transition creates an instinctual desire to pass along what you learn, because we all build on each other's knowledge. What you're going to go through is probably a lot of what I went through.